Welcome to The Fine Print, a podcast where experts at Succession Resource Group unpack the latest industry trends, recommendations, and observations for independent advisors managing their practice, with no fluff and hopefully a little entertainment. In each episode, we'll discuss ways in which you can understand and leverage the value of your business, grow your business through M&A, but also through an optimized organizational structure. Improve and protect your business to create a sustainable enterprise that can hopefully outlast you. And lastly, preparing for your eventual retirement and how to maximize that result. We're not just tackling high-level concepts, hence the title. We're getting into the details, or the fine print. So, we encourage you to listen in with whatever beverage suits your preference, and let's get to the forefront of industry trends with a fresh perspective to help you achieve your long-term business goals. Welcome back to another episode. This is your host, David Grau, president of Succession Resource Group. Today's episode is going to be a little bit shorter and intentionally more narrowly focused, building on a topic I touched on in a previous episode, where we focused on private equity, industry aggregators, and their impact on value, valuation, even succession to some degree in the financial services industry. So what I want to focus on today is something that, frankly, if you have looked at mergers or acquisitions, growing your business, maybe even selling it in the near future, this is probably something that you've done some research on, attended sessions at industry conferences. And so I want to talk very specifically about how do we pay for these businesses, whether it's an internal sale, whether it's an external sale, big firm, small firm, rapidly growing, or sort of retired in place. There isn't a single right answer, but I would say the universal truth there is value and the terms are inextricably linked. Now, that sounds obvious on the surface, right? Yeah, but, and it's always the yeah, buts that get you. So what I want to focus on is, I guess really at its core, it's risk. When you're buying or selling any business, certainly a financial services business, a service business with clients, that it's a valuable asset. I get it, but it's an asset that can ultimately vote with its feet. So when it comes to buying these businesses, there's risk inherent in these deals. And the question is, how do we mitigate it? Who bears that risk? And what are those trade-offs? Historically, a little bit of a history lesson. So just to set the table, if you go back, let's just say even 20 years. So the early 2000s, when I first started doing this, when you bought or sold a financial service business, in hindsight, it was relatively easy. I'm not sure why people paid us. I mean, at the time, it was kind of cutting edge. But for the most part, folks paid 2 times recurring revenue, 1 times non-recurring revenue. It was about 1/3 cash down, 1/3 on a promissory note that the seller financed, and 1/3 on an earnout. Again, also seller financed. Earnout being a contingent way to pay somebody. I'll pay you a percentage of the revenue for the next 5 years. That was every single deal. A great practice got 2 times recurring, 1 times non-recurring. And they got maybe a little bit more cash down if it was a really, really good practice. But in general, they got 1/3 down, 1/3 note, 1/3 earnout. A fixer-upper, a not so good practice got, you guessed it, 2 times, 1 times, 1/3, 1/3, 1/3. It was pretty much every single deal with small variations. Usually when you had the small variations, it was because it was a peer-to-peer deal. We had a long-standing relationship. I don't have any money to put down. I wasn't planning on getting the call from you about retirement, but I'd love to buy your business. We're both committed, and so I'll put what I could pull from my home equity line. I'll give you 5% down, and we'll finance the balance. Everything was financed generally over a 3 to 5 year period. You fast forward, industry evolves, we got a decade of deal making. Now here we are in the 2013-14 range. You start seeing industry lenders come into the space. I mention this because all of a sudden we went from having deals historically done over 3 to 5 years, 1/3, 1/3, 1/3, to now things sort of being upended where sellers never liked financing those deals anyway, right? It's them getting paid back with their own cash flow in an industry where by the time they were retiring, most of the revenue was coming from trails, 12B1s, insurance renewals, maybe, back then a little bit of financial planning that was still pretty consistent if they charged for it. Again, it was a very predictable business model, very predictable revenue stream that generally over a long enough period grew with the markets. So I say that as a backdrop for that was a real impediment, the financing to succession planning, because you'd hear the question over and over and over. Why would I sell my business to you for 2 or 3 times the recurring revenue when I could just stay, not really work, and earn the next 2 or 3 years worth of income and then maybe sell it at that point, maybe not? Well, that changed in 2013-14 when you had some industry financing all of a sudden available, and that paradigm shifted where, you know what, fair question, seller. How about I go borrow the money, I'll stroke you a check for that full amount, you retire, I'll pay the bank back over the next decade. Seller was more interested. So now all of a sudden, here we are in 2013-14 and to present for the most part, where the vast majority of deals are now 50, 60, 70% cash down because they're leveraging the cash from the industry lenders. Or now you're seeing broker-dealers commit capital to the space to support their affiliated advisors, and they got 10 years to pay these third-party lenders back. And then we can either bring some cash to the table, a little bit of seller financing. So from 2013-14 up till very recently, that was the general deal. And the multiples slowly crept up, which isn't surprising in hindsight, given that we had 2 to maybe 2.5 times back in the early 2000s, but squeezed into a 3 to 5 year payment window you simply couldn't really afford to pay anymore. After expenses, taxes, and debt service, you'd be eating ramen. And not like the good ramen at the fancy shops. Like, this is the stuff you buy at the grocery store that's 10 for $1. Like, that's what you're living on. So when you fast forward then, and now you've got bank financing at those same multiples, but financing over a decade, well, there's room for the multiples to start to expand, and they did in fact do just that. Now we see multiples generally in the 2.5 to 3.5 times range pretty consistently. And most of these deals, bank financed. Well, bank financing, they want an appraisal, they have lending ratios. You don't see a lot of crazy stuff happening in terms of the values and multiples because turns out banks, broker-dealers lending money, belt and suspenders. They want a low-risk deal. So what does the menu of options look like for financing? Well, it's a surprisingly short list if we hit the high-level point. There is cash up front, like actual cash from the buyer. There is cash from the buyer that they borrow from one of the industry lenders, a broker-dealer. They have access to capital now on usually a 10-year payback at reasonable rates. So you've got cash up front from the buyer, you've got cash the buyer can borrow. You then have the seller financing components whereby we could be leaning into a promissory note, which kind of by its definition is payment of a sum certain. It's like a car payment or a house payment. I promise to pay you, seller, out of the cash flow, X dollars per month, principal and interest, until I pay off the total amount of this promissory note. So you get into security and collateral and other concerns that a seller has with seller financing, but promissory notes, very common historically, a little less common now, but definitely still a tool in the toolbox. With promissory notes, you oftentimes see retention clauses, whereby if we're going to have some seller financing, we're going to have a clawback or retention clause that says if we retain 90% or more of the revenue, assets under management, or clients, lots of different ways to structure these things, who get 90% or better, then you get all your payments on time and as planned, whatever the payment schedule was. If we go below 90%, then we're going to claw back, hence the name, we're going to claw back some of that purchase price to account for what we didn't receive. Now again, this is where the industry expertise in working with a firm like ours can come in handy, how you structure that clawback to mitigate your risk while not exposing the seller to too much undue risk relative to the markets. It's as much art as it is science, but there are promissory notes that are fixed. There are adjustable promissory notes that have clawback mechanisms built in or tied to them or the deal. The other payment method that less common now, more common historically, is earnouts. 2 different flavors of earnouts. There are earnouts for a fixed amount, where I agree to pay you, listener, 25% of the revenue until I pay you $1 million. If we do well, the markets hold up, transition successful, you may get that money in 4 or 5 years. If they don't go so well, it could be 8 or 9 years, but you're going to get the amount. It is an earnout for a fixed amount. I pay and I pay and I pay till I pay that thing off. The more common earnout is an earnout for a fixed period of time where I pay you a percentage of revenue, and I agree to do that for 5 years. At the end of 5 years, if things went well, you may get more than we originally anticipated. If they didn't, you won't. So it was a very contingent way to make payments. You don't see those nearly as often now. A, because sellers really never like them to begin with, given how contingent they are. But B, they're tough from a compliance perspective. If you're in the RIA space, you've got some additional option and flexibility. But if you're under a broker-dealer, for example, you never want to be construed in any way, shape, or form as redistributing securities dollars. So it's just tricky. You don't see a ton of earnouts out there, but it's still, again, a tool in the toolbox. So if you run down the list, what are the ways you could pay for these deals? Cash down from the buyer, cash down from the bank, promissory notes, earnouts. Now, again, lots of different iterations, different combinations, even with the bank financing. We don't have to give the seller all the money at closing. We can now do bank holdbacks where they disperse some of the funds, but not all of them. We can use contingent escrow payments. Point is, it used to be relatively simple, and it's not overly complex now, but there are a lot of different terms. Again, the purpose of this podcast, focusing on the correlation of price in terms, depending on which of those items you pick from the menu and how we allocate that, retention clauses, all these things shift risk. As we shift risk, as we shift cash flow around, longer, shorter periods, those things have a very real and direct impact on the value either that you're willing to accept as a seller or the ability to pay as the buyer. And then enters private equity, the industry aggregators, frankly, just more savvy buyers who are getting more creative and wanting to win these deals. They don't want to play the bridesmaid's role. They understand for a lot of the sellers, it's about getting the highest value that they can get. I mean, the sellers still want a good fit, mind you, but they also, they do want a good value. And so now you're starting to see offers made where I'll offer you on a $1 million fee-only RIA, I'll offer you $5 or $6 million, which by historic standards would sound insane. If I'm giving you the next 5 or 6 years of top-line revenue, I mean, as a revenue multiple, it's literally what we're saying, that could be the next, 8 to 12 years of profits or earnings. Pretty high multiple for a service-based business. But we're seeing those offers out there regularly. The difference is, again, that's why I go back to the auspice for this session, is talking about that correlation, positive or negative, of the deal terms and the valuation or perceived value. When you look at these offers now, at these what would appear to be, by historic norms, obscenely high multiples of revenue or multiples of EBITDA, doesn't matter which one we use, the multiples are much higher than we see in general, certainly in general historically. But the way they're getting there, when I look at a term sheet from even just 5 or 6 years ago, you'd have the offer price on page 1, which, if it's $1 million, keep it real simple. $1 million fee-only practice, nothing crazy. There's lots of those practices out there. They're great, very efficient. Most of the time, I'd be offering you something like $2.5 to $3.5 million, and the terms will be described on the next page or two. The deals we're seeing now, much more experienced buyers, much more savvy, working to provide the seller what they ultimately want, which is more perceived value. And so they'll get an offer now sometimes in the 4 times, 5 times top line revenue range. And you think, well, how in the world are they doing that as a competitor or competing for that same practice? Well, they're doing it because now you read through the terms and it's 4 or 5 pages and it's much smaller font. I mean, at the end of the day, nothing has changed. There isn't magically more revenue being created. There's not this magic consolidation event that's creating more revenue that nobody ever had before. It's the same amount of revenue, plus or minus, maybe some margin expansion. But in general, it's the same practice. It's the same cash flow. It's the same taxes. That hasn't changed. So what has changed? How are they making offers, legitimate offers? I mean, I'm looking at a client folder here with 6 different offers from very large, well-established organizations with a broad range of values. And they're all consistently north of 4 times revenue or north of 9 or 10 times EBITDA. How's that possible? It's possible through those terms. And so this is the devil's in the details. But I hate to even call it a devil. It just, the details are in the details. And so it's important to dig in and sort of start to unpack that together as an industry. And it's what I want to talk about now, which is as you think about selling your business, or if you're listening today and you're earlier in your career, or frankly not, but you're looking to grow through acquisition, whether you're an industry aggregator, PE firm looking to make an investment, or a peer, maybe even an internal successor, I'll hesitate to say, as you're on the buy side or sell side, the key is it does ultimately come down to cash flow. Doesn't matter how you skin the cat, about cash flow. So how are they doing those deals? How are buyers getting more creative, more savvy? And what does a seller really need to know? Well, we're squeezing a balloon to some degree, but it's an important squeeze. You should think about putting together an offer. If you can tell the seller's top priority is price, and to some degree, we're all kind of guilty of that, right? I mean, price is important when we sell our business. We only get to do it once. We want the most value for our life's work. It's not uncommon now, though, to see offers being made where it's instead of 70 to 80% cash down and 20% retained for 12 months to account for some attrition with an ongoing compensation plan. Well, doing that deal where you have all of your money paid within 12 months, we've still accounted for a little bit of risk, and then paying the seller to be around to support the transition, provide some part-time work, create some continuity, if you will. Those deals are still, because of cash flow, after expenses, taxes, and debt service for the buyer, 3 times, maybe 3.1, 3.2, when you net it all out, leaves a little bit of free cash flow in most deals for most buyers. The multiples won't go much above that under normal circumstances. The way we get higher than that is to a little bit, by comparison, feel like we're kind of artificially inflating it, but we can inflate it. And the way we do it is through less cash outlaid up front, because again, especially if you're trying to aggregate and buy multiple businesses, whether you already identify as an aggregator, whether you plan to identify as an aggregator, or you just want to try and do multiple deals over the next decade, you can't give away all your cash. So they'll do, in many cases, 20 to maybe 30% actual cash up front. You'll generally see another third nowadays being paid in the buyer's stock, buyer equity. So now we're at 2/3. And again, when you read page 1 of these offers, it'll say we're making a 2/3 cash down payment. You think, well, that's exciting. David doesn't know what he's talking about. Keep reading. Again, the way we can get these values high enough for you as a seller listening to really get the juices flowing and get you excited, something in the 4 times, 5 times revenue range, or again, double-digit EBITDA range for a service-based business, is by getting creative with the terms that helps me manage cash flow. So we do that by virtue of a smaller down payment. If we're going to have a larger down payment, it's by virtue of me not using my cash, but using a combination of cash and stock in my company. Oh, by the way, the stock in my company, we're growing pretty quick, so we're going to have an aggressive valuation. My multiple that I'm using, it might boil down to something closer to like 20 or 30 times EBITDA. But again, we're fast growing. This is the opportunity of a lifetime to get paid with our stock. So doing smaller down payments, more paid in company equity, and then contingent earnout payments effectively, where we're going to lay out some growth targets. And if you, as the owner of the firm we're buying, can be there to support the transition, hit these growth targets, you're going to see all of that money and maybe then some. The challenge is it simply isn't an apples to apples comparison. So it's not fair to say, well, I got a valuation from fill in the blank. SRG, one of our peers' competitors, your local CPA, your local valuation expert, I don't care who it is. You have a valuation that says your $1 million fee-only RIA is worth $3.1 million. And then you have offers sitting on the table over here for $5 million. And you think, well, what gives? These two things just simply, they don't mesh. One of these folks must be misinformed, when in fact, neither are misinformed. It's about shifting the terms to give you what you want. And maybe this sounds obvious, but it still bears reiterating so we're all on the same page, both buyer and seller. If the seller is talking about wanting the highest value, we can do that. In fact, if you want 6-7 times top line revenue, if I get creative enough with my spreadsheets, I can propose a deal structure that will support a much higher value. And that's ultimately what we're seeing. If you're on the inverse side of it, you're a little bit more risk averse, 65, 70, you're ready to retire, and you just want to exit stage left, I really would just like cash or mostly cash up front, or at least within the first year, and maybe some kind of part-time consulting contract to keep working. You can get that deal too, but that deal won't be at 5 or 6 times. It's not going to be comparable to the aggregator deal or the more creative buyers that are working to provide you the highest price. If you want that really high price, and I get it, it's interesting, it's enticing. The point of this session is just simply go in with eyes wide open, go in with an open mind, but also I would suggest know your priorities. If your priority is the highest price and you're okay because of personal savings, whatever it is, you don't need the full value from the business and you're willing to take a flyer, put it all on black, if you will. And I won't say you're not putting this all on green, if you get the analogy. This is, there's a good chance, maybe not quite 50-50, but there's real odds that you can get obviously the cash up front in these aggregator deals. There's decent odds that ultimately their stock might have some value. Maybe it's liquid, maybe it's not, maybe they hit their growth targets, maybe they don't, but let's give them the benefit of the doubt. And then we have the other third component, which is the earnout component, hitting these growth targets. Again, maybe if we can hit the growth targets, the markets hold up. I mean, there's some things here that we're assuming. My concern on your behalf as a seller looking for those higher values and willing to take a flyer on these deals isn't any one of these factors in a vacuum, but it's the combination. We need everything to hold up. I need the markets to do well to hit the growth targets. I need the markets to do well for the aggregator or buyer's stock to really have much value. I need them to be very well run on top of that. You just start to have a combination of factors. And the hard part is if we assign them, 50% success rate of each of these things happening, when you start applying fractions to fractions to fractions, your odds of seeing that full value, the 5 times, it just begins to diminish. And so we get concerned sometimes for advisors who are exiting that get these offers and they decide to take a flyer, really understanding what it is they're signing up for, because they have spent 2-3 decades sometimes building these amazing businesses, amazing teams, trusted client relationships, only to auction them off to the highest bidder at the last minute, and then to be disappointed 3-4 years later when they're not hitting those growth targets, because the growth targets were kind of aggressive for an advisor who's in the twilight years of their career, who's been slowing down, and now we have to get back to ramping up, while also tied to a different set of systems and processes, because again, these aggregators don't come in and act as passive buyers. So it's about going in with eyes wide open. If you want the highest value, you can get it, but you have to be flexible on the terms if you really want to get those values that you're hearing talked about. And nobody talks about the combination of those two, or at least not necessarily in the same conversation. Can you get a duffel bag full of cash and a part-time job if you want it, or just walk away and retire? Yes, those deals are out there too. But again, where the aggregator deal, those more creative deal terms, put more of the risk onto the seller, the all-cash deal, or the largely cash deal, puts the risk back onto the buyer. And it's not that the buyer won't take that risk. It's not even to say that there aren't some ways we can try to mitigate a little bit of that risk, but at the end of the day, if they're going to have most or all that cash paid in a very short window of time with maybe one retention clause, the price won't be as high as paying you 1/3 down, 1/3 stock in my company, and another 1/3 on an earnout purely performance based. They're just very different deal structures. They're very different risk profiles, hence the very different values. So there isn't a right or wrong answer. There are buyers out there that will pay you all cash up front and let you retire in the next 6 to 12 months happily. There are buyers out there that will pay you most of your money up front and hire you to work part-time for as long as you want to do it. There are also buyers out there that will stroke you a check that seems somewhat unbelievable when you see the initial letter come across your desk. But as you get further into the deal, as you unpack the terms, you can quickly see and realize how and why they would do that deal for you and others in the industry. It isn't a bad deal. It's only a bad deal if you don't understand the risk profile that goes along with it. And that's true on the buyer side. If you don't fully understand the risk profile of a cash deal or largely cash deal when buying the seller's business, or if you're on the sell side and you're taking this term sheet that has some really interesting terms that you've never seen before, with a buyer who you've never had any experience with, well, if you're willing to take that level of risk to get that potential value, fantastic. Just go into it with eyes wide open, because the deal terms, the valuation, these things have gotten a lot more, I'll say complicated, but also a little bit more interesting. You have more choices than you ever had before. But the beauty is, talking to you specifically as a seller, if you're listening, with choices comes value. And the more time you give yourself, the more choices you're going to have, the more optionality. It just simply makes the whole process a lot more fun. It makes it feel like you're in control, but it does require now doing a lot more homework than we used to have to do historically. It used to be, a quick Google search, a phone call or two, and you sort of went beyond knowing enough to be dangerous. You had a pretty good idea, lay of the land. You'd still need, a firm like ours to come in and help paper the deal, do the valuation, just sort of validate everything, fill in some blind spots for you. But you could generally figure this stuff out. And I'm not saying you as buyers and sellers can't today, but things are definitely more complicated. There's a lot more options. Buyers are a lot more savvy. Sellers are a lot more savvy. So give this topic the time and attention it deserves. If you want to sell your business internally to your key team, ideally, you're probably going to need 7 to 10 years. And that's once you have the team established and identified, to ideally gradually transition the ownership and value and not have to really take it on the chin from a value perspective. But you can get a fantastic value, very close to what you'd get from an outside third-party buyer on an internal sale, if you are a student of the game, if you do your homework and you start the process early enough. On an external sale, when the time comes, you have a broad range of options, not just in the terms and the value, obviously, but also who's the right partner for your firm, who's going to take over, who's going to take care of your clients. And then you have even more options than ever before on the terms you accept and how that impacts the value and what your priorities are. So I hope today's session, at the very least, has provided some additional context, get the gears turning, because the values we're seeing out there today, they're all over the place. We see 2 times, 2.5 times all cash deals. I see 5 and 6 times top line revenue multiple deals that take 7 or 8 pages to describe the terms, but they're very real terms. And as long as you go into each of the deal structures, understanding what your priorities are. Is it the highest value? Is it the best terms? My takeaway here in summary is go into the sale or the purchase with eyes wide open, having done your homework, and know what your priorities are, especially if you're listening today as a seller. What do you want? Do you want the best possible fit for your clients? Do you want the highest value? Do you want the biggest check at closing? Are you willing to take a flyer and take some risk on in exchange for a much higher value? But do know, as you make these choices, it reminds me of that saying, I think it's in sales and marketing. As you look to buy something, you can have it good, fast, or cheap. You can probably have two. You can't have all three. It's no different here as you contemplate selling, buying. We can have a great value. We can have very low risk terms. We can have a fantastic buyer. We can probably have two out of those three. We're not getting all three. If you think you have all three in your deal, either A, I'll high five you for being the exception, but I've yet to meet the exception. In reality, there's just something in here that we're missing. And unfortunately, it's that old poker saying, if you don't know who the sucker at the table is, well, it might be you. So my job, if nothing else, is to try to help make sure that it's not you. So hopefully today's session helps better understand the trade-off between terms and valuation. The valuation you get when it comes time to sell your business, it likely will not be the final number that ends up in your purchase and sale agreement. I don't care if it's an internal succession plan, a sale to a peer, or an industry aggregator. Because as we get to doing the deal work, that is so heavily influenced now by the terms. And we didn't even get into the tax structure for the deal or the compensation for the seller. All these things influence the cash flow, which influences the value. So I hope that helps as you sit here listening today. If you're a buyer, just to reiterate, to reaffirm things you hopefully already knew, and that is 2 ears, 1 mouth. Talk to the seller, listen, ask questions, figure out what their priorities are, and then put together a deal that meets them where they're at. If you're a seller, the buyer has 2 ears, 1 mouth. They're listening, so make sure you know what your priorities are before you begin down this road. And I'm not going to say your priorities can't change, but try to figure out what your priority is and stick to it. Then the buyer can solve for it to make sure you end up with a win-win deal. And that concludes another episode of The Fine Print from SRG. We hope you found this episode both interesting and valuable. We encourage you to check out our website at www.successionresource.com. And of course, connect with us on social media for the latest happenings here at SRG. If you just can't get enough of The Fine Print, we invite you to join our monthly webinar series and newsletters where we address many of the topics covered in this podcast in greater detail. Finally, if you enjoyed today's episode as much as we did recording it, please leave us a review, a good one, mind you, and tell your industry friends about us. Your support helps us continue to bring you the best content possible. The information covered and posted represents the views and opinions of the guests or individual hosts and not necessarily the views or opinions of Succession Resource Group. Content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional advice, as amazing it might be. Always seek the advice of an expert with any questions you may have. As always, we at SRG stand ready to help when you're ready.